Welcome to the deep dive. We've got a really dense stack of sources from you covering everything from November 10th through the 17th.
Right. And our job, as always, is to sift through all that noise for you.
To find those specific insights, the high value knowledge you can actually use.
And this week was defined by these huge, almost contradictory shifts. On one hand, you have this major political crisis finally getting resolved.
The federal government reopening.
Exactly. But then at the same time, the financial markets just get slammed by this massive policy uncertainty and a really serious loss of momentum in tech.
Okay, let's start with the big political story. The federal government is back in business after the longest shutdown in U.S. history. Now, on the surface, that should mean things are getting back to normal.
You would think so. But the immediate economic consequence was, well, it was anything but normal.
How so?
Well, the people are back at their desks, sure, but the sources are all pointing out that this did not just magically fix the data problem.
Right.
We're now in what analysts are calling a data fog. It's going to take days, maybe even months for some agencies to get back on track and actually compile these reports.
And that's not just some, administrative headache.
Yeah.
That delay has a direct, and I'd say pretty scary, impact on investors and policymakers.
Yeah.
It's a huge blind spot.
It's a massive blind spot. The real problem is that key economic numbers are delayed, and some might just be gone for good.
Gone for good? Like what?
Key reports. The CPI report, which is, how we track inflation, and crucial parts of the October jobs report, they're just unavailable.
Wow.
So the market is forced to trade on sentiment, on tone, on guesswork, basically anything but the fundamentals.
It's like everyone's flying a plane in a storm with no instruments.
Yeah.
Especially on inflation and jobs, which are the two things everyone is watching. I saw that quote from Kevin Hassett.
Yes, the White House National Economic Director. He really nailed it.
What did he say again?
He said, we're going to be staring a little bit in cloudy weather for a while until we get the data agencies back up.
Cloudy weather.
And that's not just him being cautious. That's an admission that the very foundation of how we analyze the economy has been, temporarily yanked out from under us. For you, this matters because when the facts disappear, every decision becomes riskier. Every whisper from a policymaker suddenly gets amplified.
Which is a perfect lead into the Federal Reserve.
Yeah.
They're in this impossible spot, having to talk policy without the very data they need.
And at the same time, you're seeing this growing hawkishness from Fed governors becoming very, very public.
It really is fascinating. The sources are framing this as maybe the most divided Fed we've seen under Chairman Powell.
Possibly one of the most divided in recent history even. And you'd think a lack of data would make them, stick together, be cautious.
They did the opposite.
It did the exact opposite. It just exposed these deep ideological cracks.
And you could see the market reacting to that infighting in real time.
Yeah.
The effect was just dramatic.
Oh, absolute dramatic. Think about this. The probability of a rate cut in December, at the end of October, the market was pricing that in at 93%, a near certainty.
A done deal.
A done deal. And by November 17th, it had plummeted to just 45%.
Wow. That is a massive repricing of risk in just a couple of weeks.
And it was driven almost entirely by the Fed's change in tone, by this public disagreement.
So if they don't have the hard data, what are the two sides, the doves and the hawks, even arguing about? What are they basing their cases on?
That's the most dangerous part. It's policymaking based on models and priors when the evidence is gone. The Wall Street Journal had a great breakdown. The doves, they're worried the labor market is softening up.
But they can't prove it.
They can't prove it, not with any new data anyway. And the hawks, they see an opening and they pounce. They're arguing for a pause. They're pointing to older data like steady consumer spending. And they're saying they're worried businesses are about to pass on tariff costs.
So they're saying inflation is the bigger risk.
Exactly. But the source material points to an even deeper, more fundamental debate they can't solve right now.
Which is?
It's why new hires are declining. They can't agree.
Okay, what are the two theories?
Is it because demand is lower, the economy is weakening, maybe heading for a recession? Or is it because the supply of workers is falling, maybe from less immigration? If it's a demand problem, you cut rates to boost the economy. But if it's a supply problem, not enough workers cutting rates will just pour fuel on the fire. It'll cause inflation without actually fixing the problem. And without good, timely data, they are stuck. They're basically arguing over the cure without even agreeing on the diagnosis.
Okay, let's pivot to the markets, because all this turmoil didn't just stay in Washington. For the second week in a row, tech stocks were pulling the whole U.S. market down.
This is a clear sign that momentum has broken, that confidence in those really rich valuations is starting to crumble.
And we saw some key technical levels get breached.
We did. Both the S&P 500 and the tech stock index fell below their 50-day moving averages. And for anyone who doesn't follow charts all day, that's a widely watched signal. It suggests short-term momentum is gone and a trend might be reversing.
And the reasons for the drop aren't a big mystery. It's exactly what we've been talking about.
Yep. Two main causes. First, that huge drop in the odds of a December rate cut, that makes money more expensive.
And second,
just growing anxiety about the sky-high valuations of these AI companies. I mean, when the Fed basically says the cheap money party is over, the market suddenly starts to care about how much you're paying for stocks.
all this uncertainty has kind of funneled down into a test for one single company.
It really has. Everyone is now laser focused on NVIDIA's earnings report, which is coming up on Wednesday.
It's the last of the so-called Magnificent Seven to report.
It is. And the market is going to scrutinize every single word. Because look, these companies have spent billions and billions on AI.
Massive capital investment.
Massive. And investors need to see the proof. They need the revenue, the profits, the margins. They need hard evidence that these huge AI bets are actually going to pay off and justify these premium stock prices. The market is basically looking to one company to save the day because the bigger economic picture is just too foggy.
And that pressure caused a big rotation in the market for the second week running. Where did the money go?
Well, let's talk about where it came from first. Money flowed out of two places. First, growth stocks. Their valuations just look too rich with rates potentially staying higher.
Okay.
And second, small cap stocks. This is really important. Small companies are super sensitive to rate cuts because they often rely on debt to grow, and that debt is often at a variable rate. Higher rates hit them harder and faster.
And where did that cash find a new home?
It went into value stocks. They're much cheaper. They often pay dividends.
And if you look at the numbers, you can really see the scale of this shift. Small caps got hit hard.
They got hammered. Small cap stocks fell 4.7% on the week. Growth stocks were down 3.3%. Meanwhile, value stocks only fell 1.8%. That is a very clear signal from investors. They're moving to safety and cheaper assets.
And what's really interesting is that this was mostly a U.S. problem.
Yeah, that was a key detail. This weakness was highly concentrated here. Developed market stocks outside the U.S. actually managed a small gain.
They were up, what, 0.7%?
Up 0.7%, yeah. A material outperformance. It really suggests that this particular storm, the divided Fed, the tech valuation test, is a distinctly American issue right now. Emerging markets were down about 2.2%, so they basically tracked the U.S.
So just quickly, what about fixed income? What was the bond market's reaction to all this confusion?
The bond market pretty much mirrored the uncertainty. We saw a slight sell-off last week.
And when bonds sell off, yields go up.
Yields go up, exactly. The yield on the 10-year Treasury rose about 2.3 basis points. It closed the week at 4.13%.
Now, a basis point is 1/100%, so that's a pretty small move.
It is a small move, but the direction is what matters. It just reinforces this one central theme. Bond investors are waiting. They are desperate for clarity. They want hard data on what the Fed will do next, how strong the economy really is, and where inflation is actually going.
So everything comes back to those government agencies getting up and running again. Because the signals from the Fed are all mixed up, and the signals from the economy are, well, they're just missing.
So let's try to tie this all together. The core tension in all the sources you sent us is pretty stark. The government is technically open for business, but the reliable data we all depend on just isn't there.
And this is happening at the exact moment the Federal Reserve is more divided than ever.
And the result is what we're seeing in the market, these big rotations and this very sharp, very sudden shift away from tech momentum.
So what does it all mean? It seems like the market's obsession with NVIDIA's earnings is a direct result of this data fog.
I think that's exactly right. Without good, broad economic numbers, the market is forced to look for answers in a microcosm. It's looking at one company's earnings report for some kind of sign, any kind of direction, because the big picture is just too blurry to read.